Hello and welcome back to the Advanced Financial Management lesson. Today we are going to cover the relevance of the various forms of portfolio reconstruction. The various forms of portfolio reconstruction. Each of the various forms of portfolio reconstruction serve distinct purposes and offer unique benefits depending on the company's specific goals and circumstances. So we are going to identify the relevance of each form of portfolio reconstruction, beginning with divestment. What is the relevance of divestment? Now, divestment is ideal for shedding underperforming assets. It is ideal for refocusing on core competencies and raising capital quickly. So that's the relevance of divestment, shedding underperforming assets. Shedding underperforming assets. That is one relevance. Shedding underperforming assets. The reason why a company may shed off underperforming assets is so that the company can also refocus on core competencies. To refocus on core competencies and raise capital quickly, because the investment means or may involve selling off the company's assets, which can be a way to raise capital quickly. So that is the relevance of the investment. The second form of portfolio reconstruction is demerger. Demerger or spin-off. Now, spin-off or demerger is excellent. It is excellent for unlocking hidden value. Excellent for unlocking hidden value. When a company demerges, then it unlocks hidden value. That is one reason for demergers. All right. Another reason is or relevance. Another relevance apart from unlocking hidden value of high growth subsidiary or division is that the merger allows separate entities to focus on specialized activities. The second or third form of portfolio reconstruction is liquidation. What is the relevance of liquidation? We all know that liquidation is the last resort. It is a last resort that is used to recover some value from insolvent companies that can no longer operate. All right? It is a last resort. It is used as a last resort because to liquidate is to sell off company assets, then the proceeds are then used to pay creditors. So that is the relevance of liquidation. 4, sell-offs. Sell-offs is another form of portfolio reconstruction, or what we call asset sale. Sell-off or asset sale is a form of portfolio reconstruction, and it is a flexible tool for quickly raising capital. Raising capital quickly. That is the relevance of sell-off. Raising capital quickly, streamlining operations, and also adjusting to changing market conditions. 5, equity carve outs. Equity carve out is another form of portfolio reconstruction. And equity carve outs provides access to capital markets while retaining control over a subsidiary. Provides access to capital markets. Provides access to capital markets while controlling the stakes in the subsidiary company. You understand? While retaining control over a subsidiary and also testing investor interests. Tests investor interests. You recall equity carve-outs includes or involves selling the parent selling the minority interest to the market and raising capital from the market, and that's one way to test investor interest in the group of companies. Equity carve-outs. 6, we had studied strategic alliances. What is the relevance of strategic alliances in portfolio reconstruction? Now, strategic alliances enables a company to access new markets. Access new markets. A company can enter into an alliance with another company with the view of obtaining market which the company may not be able to attain on its own. So that is the relevance of strategic alliances. All right. Strategic alliances can also enable a company or companies to share resources. That is another reason for strategic alliances, sharing of resources, and also to collaborate on innovation without a full merger. Moving on to the 7th form of portfolio reconstruction is management buyout. Management buyout. What is the relevance of management buyout? Now, management buyout empowers existing management with ownership. Empowers existing management with ownership. It empowers existing management with ownership. Because we say that management buyout is where the existing management take over the control of a company. They buy the company. Buy out. Management buy out. Empowers existing management with ownership, driving long-term vision and strategic alignment. 8, leveraged buyout. Leveraged buyout. Now, candidates will recall these forms we had discussed in detail in our previous session. Here we are only looking at the relevance of the forms of portfolio reconstruction. Now, the relevance of leveraged buyout is to attract investors seeking high returns through financial engineering. It helps, or the relevance is to attract investors seeking high returns. Attracts investors seeking high returns. Attracts investors seeking high returns. That is the relevance of leveraged buyout. Attracts investors seeking high returns through financial engineering and operational improvements. Another form of portfolio reconstruction is management buy-ins. Management buy-ins is yet another form of portfolio reconstruction, and the relevance of management buy-in is that it infuses fresh perspectives and expertise to revitalize struggling or companies that are under distress. Management buying is where external team of management buys a company. All right. Management buyout is where the management of a company buys the same company, but management buyout, these are external management team that comes in to buy an existing company. So what is the relevance of management buy-in? I'm saying it infuses fresh perspectives and expertise. Infuses fresh perspectives and expertise, because these are external team of managers. So these are reasons for different forms of portfolio reconstruction. The relevance of portfolio reconstruction, and candidates, the relevance of each method depends on several factors like financial objectives, that is to mean whether the company aims to raise capital. Another aim could be improving profitability. Another aim could be reducing debt or even maximizing shareholder value. So the relevance of each of these method or form of portfolio reconstruction may depend on financial objectives. That is number one. Number two, the relevance may also depend on strategic goals. That is to say, the company's long-term vision and how each business unit aligns with that vision. So the relevance may also depend on strategic goals. Another factor, or let me put them down, these are important points, factors. These are factors. I'm saying that the relevance of each method depends on several factors. The relevance of each method depends on several factors. The relevance of each method depends on several factors. One factor I've mentioned is financial objectives. Financial objectives, and I've mentioned profitability, increasing shareholder wealth, reducing debt. Those are financial objectives. Whether the company aims to raise capital, improve profitability, reduce debt, or even maximize shareholder value. I've also mentioned strategic goals. Strategic goals. The relevance of each of these forms of portfolio reconstruction depends on a company's strategic goals, the company's long-term vision, and how each department or subsidiary or business unit aligns with that vision. Market condition is yet another factor. All right, market conditions. The economic climate, the industry trends, and even investor sentiment can all influence the effectiveness of different reconstruction methods. D, organizational culture is another factor. The company's risk tolerance, and even the company's willingness to undergo significant change is a factor that will determine the relevance of the various forms of portfolio reconstruction. So these are 4 factors. And candidates selecting the most appropriate form of portfolio reconstruction requires careful analysis and consideration of all the relevant factors. So it's essential to evaluate the potential risks and also the benefits of each option, and to develop a comprehensive plan for implementing the chosen strategy. If it is the investment, then there has to be a plan. If it is demerger, there has to be a plan, comprehensive one: liquidation, sell-offs, equity carve-outs, strategic alliances, management buy-ins, management buyouts, leverage buyouts, management buy-ins, and so on. So that's the end of the lesson. In this lesson, we've discussed the relevance of various forms of portfolio reconstruction. These forms we discussed in detail in our previous lesson. That's why I didn't take too much time defining, because we had defined in detail in our previous session. I will leave you with the following assignment. 1. In what ways can portfolio reconstruction strategies create shareholder value, and what are the key factors that contribute to the success or failure of these strategies? Number 2. How does portfolio reconstruction help companies to refocus on their core competencies and shed underperforming or non-strategic assets? Number 3. Explain how portfolio reconstruction can be used as a tool for companies to adapt to changing market conditions, technological advancements, or competitive landscapes. 4. In what situations can portfolio reconstruction be an effective solution for companies facing financial distress, and how does it complement other restructuring efforts? Number 5. How can portfolio reconstruction unlock hidden value within a company's assets or business units, and what are the potential benefits for investors and the company itself? In our next session, we will discuss organizational reconstruction. Bye-bye.